Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
Welcome to our Avenue third quarter portfolio report. And we just got our quarterly results out last week. And so we just want to do an update today. Bryden's actually written a great essay on our portfolio. We're going to get to that in a minute, but I think I just want to introduce the topic this week by saying, for this quarter, saying the temptation is always to go into, this is what's happening in the economy, and this is what's happening in the stock market and all the different pieces. And I think you did a great job of taking us back from that and saying, we talk about all that stuff, but really what we're doing at Avenue is following this very specific script in terms of trying to find these businesses and how do we hold on and compound our wealth in very specific types of stocks in the stock market. So the other thing that really dominates the news right now is interest rates. I will touch on, we're not going to go deeply into that, but it's just to bring up where we are exactly here this week, which is we had that extraordinary inflationary post-COVID spike of the last year and a half. And we said this mechanically inflation was going to come down. This is for the last couple of quarters. We're now under 2% inflation in Canada. And interest rates are, if we're looking at what the stock market, longer term, 5-year, 10-year interest rates, you're calling them basically 3%. So all of that has washed through the system. And then, so that's where the bond portfolio has had a great year so far this year. But now interest rates going forward are back to a low level. And then again, the knock-on from that, when interest rates go down, our interest-sensitive stocks have gone up. And so that part of the portfolio is all at all-time highs. So I just want to throw that out. So now, going to Bryden, fantastic. Like you wrote this very clear rundown. I would encourage everybody to read it in terms of, here's our investment strategy, and then getting a great idea of just a summary of what Avenue does, and then and then you sort of added this little body of the work of saying, here's the academic theory.
It's also a shorter report than the last few, which helps for
very readable, very short.
Yeah.
But in terms of here's Avenue's strategy, here's a little bit of an academic background, and then giving an example. But I'll throw it up to you. Was there anything particularly inspired you for?
I think it was, well, we've talked about this the last few quarters. I think it's, there, and we were just talking about this before we started, but I think sometimes we naturally feel this pull when we do these podcasts or in our communications to describe the environment, to provide context for the economy or what the stock market's doing or interest rates, and sort of more macro topics are very in vogue, and it's easy to get sort of lulled into just talking about that. And I think this quarter, the idea was to bring it back, like you said, and talk about what we're actually doing and why, and thinking of it from, theoretically, what are we doing? Why are we doing it? And then in practice, like here's an example of what we're doing and why. And I think the core part of the theory is, as we say all the time, is we're looking for companies and businesses that we think have a path to consistent profitability over long periods of time. And so how do we analyze that or look for that? There's certain characteristics that we believe are indicative of that kind of long-term business stability. And so some of the, not to get into the vernacular and get lost in the words, but the characteristics that we think are critically important to high quality, consistent businesses are return on capital. We'll get into what all these mean in a minute, but return on invested capital is number one. A lower or moderate capital intensity, which is internally funded, is the second. And then the third is also, business that can reinvest in itself at good rates of return. So those are kind of the three simple pillars that we look to. And then,
I feel just round those out. So again, there's a simple way of putting in common language of saying, here's a return on invested capital, but what is that? That the core thing that we screen for first. What do we actually?
So, and I think the other thing, so return on invested capital, we look at it as what is a business's profits relative to how much capital is employed in the business. And so we're talking financial capital, looking at both the debt and the equity of the business, and then how much profits does a business generate on that amount of capital. And I think why that is a good metric to look for and think about is it's something that can be easily looked at in any business. So if you're a infrastructure business, if you're a consumer business, if you're a technology, any sector, the best quality companies in those sectors all have this characteristic, and so it's very uniform in its relevance to a good company. And so,
but also it's not universal. This is the whole thing. I'm going back
No,
30,
there's
30
very
years
few-
ago, saying there's actually not that you're
It's-
screening and screening for,
Yes.
but this is actually not very many of these high quality businesses.
No, it's when you spend time looking through like, hundreds and hundreds or thousands of companies, you realize that there's in the hundreds of maybe good ones. And then of course we also care about valuation. So you filter it in, but there's thousands of companies, public companies, that are really not good businesses. And so what we try to do is avoid that by focusing on these kind of characteristics. But return on capital is important because it just tells you how profitable a business is relative to how much capital is in the business. So as an investor, either if you own the stock and the equity, or you own the bonds, which is the debt, you are a capital owner of that business. So you want to measure what level of profits a company earns on your capital. That's basically it. It's very simple, but it's not something that is as widely discussed as it probably deserves to be.
I think when we get to the theory, that's we'll hit on that because it's a great number in the essay. So, but the second one then, which is also equally important, and there's always a couple exceptions in the portfolio, but this idea of low capital intensity, and how do you put that into regular English language?
So when we talk about capital intensity, what we're referring to is, so any business, in any walk of the economy, there's a certain amount of capital expenditures that you have to reinvest in the business just to keep the lights on. Some businesses or some industries have more needs for capital every year. So if a company makes $100 and every year to earn that $100, they have to spend $20 to keep the business going, that would be the capital expenditures. That $20 is the capital expenditures of the business. And so
like a 20%. These are the whole thing. Like some of these businesses would take 20% of revenue just to keep the lights on, keep it flat.
And that's not, and we've, where we go below the hood is, breaking apart what is maintenance capital, what's growth capital, and we can talk about that in a second. But capital intensity, and there's some industries and businesses that have higher capital needs, which isn't necessarily a bad thing. It just means that the running of that business needs more capital. But what we like to do is look at capital expenditures relative to annual revenue. So that's where we get capital intensity from. And if you own companies who are highly and consistently profitable with low capital needs, what it means is there's more free cash flow to be either reinvested in the business or paid out as dividends or to be used as buyback. So the reason why capital intensity is important is that when it's lower, it means there's more profit left over for the end investor, which is essentially, what you care about is as an owner of the business, is it reinvesting in itself to grow the value of it, or is it returning that money to me as a shareholder, dividends or buyback? So either of those are great, but if you have a business that requires enormous amounts of capital just to keep the lights on every year, it just means there's less money left over for you. So, and we try to find a balance of good return on capital, lower capital intensity, and those two combined give us an indication that that business is profitable and that there's lots of cash being generated for us as end investors.
So then that's this third point, and then hitting on that, and then once you have this extra capital, it's what you do with it. And then I'll go. This is it's what capital markets, this idea of having a stock market or bond market, the purpose of it is to go and raise money. I've got somebody's got a good idea, this other guy's got money, you try to put good ideas and money together. Some businesses will constantly need to be raising money. And again, if this is the irony is we're trying to look for businesses that don't, because we've got our own money internally, we actually don't need outside money. And so this is the idea you said, being able to reinvest or having not outside. And why is that?
Yeah.
Why is that so important?
I think that's one thing too, that I think over time we've filtered and understood this dynamic more. But exactly like you said, the stock market is there to, most companies are public, to attract capital or investors, another way to say it is, in the running of their business, that business doesn't generate enough profits to either run the business or to grow or do acquisitions. So to fund those acquisitions, they have to then sell shares or increase their equity capital or borrow money. And so if company A doesn't have enough profits to go buy company B, usually what they'll do is they'll issue shares, which then kind of get promoted through the Wall Street and Bay Street, apparatus. And so you're buying a share of a business that is constantly needing that money. Sometimes that works in the very short run, but if you look at it over long periods of time, and we're long-term investors, it's far better to own companies who don't need outside capital, because in the analogy that I didn't write about it in this letter, but when we've looked at this as a simple analogy, is that you and your family are sharing a large piece of apple pie, and the larger or the more people in the room, the smaller the slice of pie. If you have less people, you get bigger slice of the pie. And so a company that is not issuing shares, it has less shareholders, has less shares outstanding. Each investor owns a bigger piece of that pie. And as it grows over time, you own a disproportionate share. But if you're having a gathering with a pie, and you're constantly inviting over new guests, and everyone gets a slice, your slice of pie shrinks and shrinks and shrinks over time. And so in the long term, it's not a sustainable way for companies to create long-term value, in our judgment.
Or as you said, it's just an awful lot harder. And there's a handful that do, but they said an awful lot that don't. And I would say also, this is what the screening process is there's our economic environment, just touching on that, is sort of benign at the moment. It's not, there's all sorts of things that we can point to that are, stressing the economy, but there's other things that are kind of okay. But there are periods of time where it's a real challenge. But if your business is self-generating, then you don't have to rely on outside markets. And I bring up that point. The stock market's great, and it all feels fine until it isn't. Mm-hmm. And then if we have this whole portfolio of really, self-financing, resilient businesses that have higher return on money, it's just a safer way to get through the periods of time where the stock market isn't doing as well. Absolutely. But the worst problem is, on a day-to-day basis, you might not notice. Each of these characteristics and the criteria that we're talking about, these are things that happen and make impacts over long periods of time, or lags. Like, you're talking about quarters and years, where the effect of companies that can internally finance, or the profitability of companies that are consistently profitable all the time and don't have large capital needs. It's like cash piling up in a bank account, but it's not every day. It's quarter after quarter after quarter over time. But these are longer, and this is why I think, as in long-term investors, that these are critical to focus on, because we're not buying a business or owning something because of what we think it's going to earn in the next quarter. We're owning it because we think it has the qualities where it's going to earn higher profits 2 years, 3 years, 5 years from now. And it's thinking out that far, and hopefully buying things at a fair price. But these are all long-term characteristics that are. So I know we're not throwing out that point, but hopefully buying at the same price. So this is the characteristics of the first thing, finding these handful of businesses. You're seeing yourself and Eric, we've got a long list of these things. We'll own a handful of any one time. But when we're touching on valuation, that other pieces, here are the characteristics, but then that central part about the valuation, and then how would you define the? Yeah,
so I think the valuation, or the other thing we touch on in the quarterly letter, is there's a research piece that we saw earlier this summer, and it kind of highlighted this issue from a theoretical angle really well. But essentially, what it highlights is that the majority of investors are much more focused on looking at a certain company's earnings, giving that level of earnings a multiple, and saying, oh, the company should be worth that, rather than understanding where those earnings come from. Does that business have the characteristics to generate those earnings consistently? Was that easy to do? Is that hard to do? And it's the way way it's described in the letter is deciphering between pricing a business and valuing a business.
And
so
it's not even sort of. I mean, when you're throwing out numbers of 93% or 95, that means most people in the industry, and just the way our brains work, we just care about the price.
Yes.
What's the price of this? Why is it going up? Instead of tending, and what we're trying to do is pull that back and say, no, we've got to value the underlying business. This is a very high quality. If we're going to own it, we're not just at 6 months, 2 years. We're going to own this thing actually for 10 years. What's the quality of the underlying business?
Yeah. And I think it drives you back to think about the characteristics that are what drive the long-term value. And but it's increasing. I mean, it's interesting how so much of the industry, the banks and you say Wall Street, Bay Street, don't think in those terms or talk in those terms or do research in those terms. And which is interesting, which again, it comes back to incentives, and it's, they have different incentives than necessarily long-term investors.
I'll touch on that. I can do that in one sentence, which is the majority of people in the financial industry, which is, we brought up the Warren Buffett quote before, but if he's in Omaha and he cares about the value of the business, and we're here, we care about the value of business. Wall Street and Bay Street cares about transactions.
Yes.
So they want to see the business do transactions because that's how they make their money. And also even just most money managers, if they're trying to trade their way to success, they really care about, what's the next thing that's going to change? What's that thing that's going to propel this stock in the next 3 to 6 months? As opposed to the patient investor where you're going in saying, how good is this business? I don't really know what's going to happen. You actually made a great comment, which I'll hit you up with, because this is the beginning of the year, going and looking at we went through all our companies and said, how are they going to do this year? And then halfway through, because we've had some real winners this year, and I love your comment of sort of saying how predictable was that at the beginning of the year?
I think it was enlightening, because we would like the idea or the thought was, January 1st of this year, we could have all sat and looked at our portfolio and understood why we thought, each line item at the time was a good business, or, why any of our investments had the characteristics that met our criteria for investing. But I never would have thought, certain stocks would have had the moves that they've had. And it was, there's a lot, I take a lot of humility I take from it, of saying on a year-to-year basis, we actually have no way to know what stocks are going to do what, but we have a very good filter to understand what makes a good business. And if you can, the argument or the idea is, over time, good businesses will reward their shareholders, but on a 6-month or 1-year basis, there's no way to know. And so to try to know, or to try to think you're going to know, is actually an inefficient waste of time, rather than focusing on understanding what you own and why. And then at the same time, constantly looking for a roster of other companies that meet your criteria. But to try to predict what a stock's going to do, there's actually no way to know it. And this is someone who at the beginning of the year I wasn't positive or negative. I would have said probably agnostic. But I never would have thought even companies that we really like would have had the years that they've had. So it kind of takes a step back to say, don't try to think about that. Think about, why are these good businesses? Let's find more like them and let's own them. But don't pretend you're going to know what's going to go up or what's not going to work.
Well, I think the example that you again gave of AutoZone and how you pulled it apart in a very simple way, again, referring to the letter of saying, here's the profitability of AutoZone. I'll jump in here and just sort of say the characteristics, again, going back to our list of characteristics. If we have, this is Bryden, we found it, and then it was 2020 made the investment, but very stable business, a fantastic track record of profitability, and also a type of business we can understand. I would just always bring that up, because you can talk about technology and just sort of go, these are great businesses. One, a lot of them are expensive. What do they really do? And are they going to be outcompeted? Where you have a very simple business like AutoZone with another, a duopoly in that market in auto repair in the Eastern Seaboard in the U.S. But here's taking just really understanding the profitability and just throwing this back to you of understanding how much compounding we've had in the core business, and the result is then a successful stock investment.
Yeah, I think what's interesting about AutoZone, and we've owned it for almost 4 years to the month. Like, we bought it in November 2020, I think. And like I would say we had an idea of what the business was or why we liked it when we bought it, but I would say it's been one of the best examples of us continuing to learn more about the business even after we've owned it and understanding the dynamics at play that lead it to be or consistent with our criteria. And essentially, it's a very simple business. It's automotive retail in the U.S. Its headquarters are in Memphis. It's been a public company since the early 1990s. There was a gentleman in in Memphis who started it. But again, if you go to you go to the U.S., you'll see AutoZone stores, and they're small square boxes. You go in, and it's all auto repair items. So
home, the guy that owns a couple cars in the U.S. and likes repairing them
totally.
himself.
And so it's like it's very much set up for the U.S. Like you've got a very grease monkey kind of culture. A lot of auto demand for auto products is stable, and a lot of the market that AutoZone caters to is the DIY, so the do-it-yourself car fixer. But it's auto transmission fluid, oil, tires, wipers, just very simple products. You walk in and every store looks the same. But why that's such a good business is that if you think about what drives the demand for automotive repair parts, it's two things. It's how many miles are being driven every year, and what is the age of cars, existing stock of cars. So simply, if you're more cars on the road driving more miles and they're older cars, you're going to have more demand for replacement products. So what's interesting about the dynamic for AutoZone right now, and I would almost say like the setup for demand for automotive products is better today than when we bought it, because the age of used cars is now at record highs. So the problem is, as new car prices have got more expensive, what it does is it puts people into used cars. After 10 years or 100,000 kilometers, most cars are off warranty. So you have a record amount of cars that are over 100,000 kilometers that are off warranty that people need and are going to drive for another 100,000 plus kilometers. If you look at vehicle miles driven in the US, it's very stable. It's about 2 trillion miles driven, and it's sort of been flat. So it's not really a growing industry, but you have stable demand. And then AutoZone and their sort of main competitor, O'Reilly Automotive, are the dominant share of that market. And so what's happening is the smaller automotive retail, it's much more challenging of environment. They don't have the supply chains that AutoZone and O'Reilly have. They don't have the infrastructure and the network and the delivery system that the AutoZone has. So the incumbents have a strong advantage. It's as much as we're in this we've been through so many of these technology waves and AI waves. There's no venture capital money going out to start up an automotive retail business, so that you don't have new capital chasing to compete. So you have a strong incumbent. They know their business well. It's a simple, stable business, and you can see a long pipeline of demand where you're going to have this very stable demand for auto products. So it's kind of simple when you break it down, and it's simple, but it's those quality characteristics are what drive the incredible profitability and the stability of it. Although if you go in and you look at a store, it looks like nothing's happening, but there's a ton of wealth being created with that business because it's generating a high amount of profits. The reinvestment needs are very low. And then it's probably been one of a handful of stocks that are the most prolific at buying back its own shares. So as you earn more profits, you reinvest. The rest of that money goes to decrease your share count. So the share count, I think, even since we've owned it, was probably 23 million shares, and now it's in almost 16 million. So they've taken a third of the share count out in 4 years.
Yeah. And I'll reemphasize that, but I want you to hit the the fun numbers on this, and then we can wrap this up. But again, it's a high of your investment dollar. It gets a high rate of return on the investment dollar. It's a low capex. It incrementally invests in its business, and then it buys back its own stock. But just hit those numbers in terms of earnings, just in the last 4 years, and an earnings per share. Also, AutoZone's one of those funny stocks. It's not a $10, $20 stock. Occasionally in the stock market, when we bought it, was a $1,000 stock.
Yeah.
But but you earn the amount of earnings that over the last 4 years. How much is this compounded?
When we bought it in 2020, the in that year previous to that, or the trailing year, it earned $75 in profits per share. In the 12 months that just ended, it's earned about $155 per share. So earnings per share has doubled in the past 4 years, which is pretty remarkable. And it's a business that has grown. It's, you would say, or when we look at it, it kind of grows in line with GDP. So nominal GDP growth. It's not a strong growing business, but when you're buying back your shares at the rate that they are and you're growing, it just means your profits go up incrementally and then incrementally and then incrementally. So we bought when we purchased it, we paid 15 or so times earnings, and it was around $1,100. And it's been a great investment for us since we've owned it. But again, going back to what we were just talking about, the dynamics or the quality of characteristics of the business exists today. And I think the outlook for the business is still very strong, even though it's done well. But because of those characteristics it has, it makes it unique. It's a great example in practice of what reinvestment of a business in a high rate of return business does over time. I know it's only been 4 years, but.
So give the stock price today, because you're setting these things up.
It's 3,200. I left that up. At 3,200. I think something like that. Yeah.
Right. So, incredible rate of return over just a 4-year piece of time. It doesn't mean you take your eyes off it. Management can change, the industry can change, the business can change. But if we have at least hanging our hat on these couple things, and coming back to the really important point too, the valuation of a 15 times business. Right today at 20 times, as long as it's growing fast, it can grow into it. There's all sorts of things that can sort of mess these things up.
Yeah.
But right now, it's just carefully monitoring these businesses, and can we own them for as long and give them as much time to compound as possible.
The other thing that's interesting on this one specifically as well, and we've got some other that are in this category, but it's been a sleepy ride for the 4 years. The stock has not had periods where it had huge runs or had huge declines. It's been a very sleepy stock this period. So I think I take that to be a positive in that we're not looking for things that are super exciting, or if something's being talked about on the front page of every newspaper,
well, then you have to replace it.
Yeah, it's become a thing. Like where I'm every time I go on BNN or I always talk about AutoZone, and they've always said, well, nobody else talks about these stocks. And which for the life of me, I don't understand, because it's been public for a long time, but it's not exciting. It's kind of sleepy, but it fits our criteria and our characteristics that we're looking for. And it's a name that we're very comfortable owning. And I think it's been a good reference point to look for other companies that have similar criteria, and it's something that we're doing. But it was the one thing about what I'll say as well is another huge lesson. This is 2.5 years ago. After the first year of owning it, it did have a good run, and I made the mistake of thinking, okay, the business is going to slow down, it's going to roll over, it's going to take time to breathe. And so we trimmed the position. We didn't sell the whole thing, but we trimmed a third of it. And because that was sort of historically the idea I had was, something's gone up, you reevaluate the business. Okay, it's more richly valued. You want to take your profit, reinvest it into something else. But it's been the most eye-opening example of when you have a really good business, and if long as it's doing what you expect it to do and it's at a fair price, the best thing to do is to not sell it, just to leave it, because you can't take a great company like that and go out and replace it with something else. There's very few things that look like that, and if you're lucky enough or fortunate to buy it relatively well, it's just let it incubate and grow over time. But that was a big lesson, just saying these things that look like this, that have these characteristics, don't replace them too easily, because they're hard to find.
Yeah, and have a long-term view. So maybe I'll finish up on this, and again, just the simple point of why we care so much and why we care so much about these characteristics in investing. And I think we come back to this with just this term, it's just safer. And it gets you through various different type of markets. And even though it sounds, everything you've said about just picking on this one example of putting the theory into practice, of how well this individual business has done, but we'd also make the case that if we had a real slow market and no access to capital, AutoZone is going to compound no matter what. The core business is going to compound. What the stock market prices it, back to that price point, we don't 100% know what the stock market is going to price, but we know from our investment, we're getting more and more value every day out of the value that we have in AutoZone. And that overall, if we keep doing this and all the parts of the portfolio do this, it's just a much safer way to invest.
Yes, no, I totally agree. And I think it's definitely not exciting, but we kind of do it that way for a reason, because we're not looking for excitement. We're looking for these other characteristics that meet our criteria. And we think that we're unique in kind of our approach and looking at the way we do. And so for us, that we lean into that.
Fantastic. Okay.
That was great.
We'll look forward to next quarter.
Yeah, sounds good.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.